Today, we will find out if Pfizer is just a one pandemic pony or a good investment choice, and we will begin right now. One constant during the pandemic was Pfizer being part of the daily news cycle as one of those companies working on getting out a vaccine as fast as possible. Whether you are a fan of vaccines or not, or even like the others better, it is still undeniable that the pandemic kept them busy. And that is not a bad thing for an investor. Pfizer has been a pretty solid investment during the pandemic, and today we are going to look beyond that and see if they are still a good choice for future profits. Before we avoid those sniffles, let me know in the comments if you are invested in any health-related stocks. I do have a few Pfizer in my USD RRSP. I am very grateful to see you all here in the home of free financial content on YouTube. If you are new, please subscribe right now so you won't miss a single moment, and a huge thank you for that click. Pfizer is a pretty massive multinational pharmaceutical company that was formed all the way back in 1849. Interestingly enough, they were around during the Spanish flu, so this is not their first pandemic. One of their earlier highlights is that they were the world's largest producer of penicillin during and after World War II, and needless to say, there was a huge demand at that time. They have produced hit after hit when it comes to antibiotics, and as a result, by the 70s, their annual revenue had already grown past the $1 billion mark. Their products have been revolutionary for human and, well, animal health too. Holy banana bread, they even created Viagra. I can't say I like all the email marketing on that one though. Pfizer has also been working on cancer research and the development of better packaging to allow their drugs to have a longer shelf life. This company was doing it all before the pandemic hit, and they stepped up big time when they were called upon. It is funny, but most people now associate them with the COVID vaccine, and as an investor, well, you really need to look at the bigger picture, and that is what we are going to do as we break down their numbers. Before I drop the first digits, I just want to point out that you have two different ways to invest in Pfizer. If you have a Wealthsimple Plus, you can buy their stock directly and sit it in your USD account, or there is also a CDR to give you a Canadian hedged TSX option. In either case, the ticker is PFE. Kicking it off, they have a market cap of $259 billion, which makes them a very large cap company. Obviously, with a market cap like that, they are blue chip all the way. Their beta comes in at 0.65, which makes them almost half as volatile as the market average. I really adore that number. When it comes to earnings, their earnings per share come in at 5.25, and dilution is not a significant factor with Pfizer. Their earnings grew by, get this, 141.6% over the last year, which is almost mind-staggering. Obviously, this was due in part to the pandemic, and as a result, that will begin to come down, and they are forecast to decline an average of 14.5% per year for the next 3 years. This does make sense, and in most cases, this would be a concern, but in this case, it's not a real concern. Their price-to-earnings ratio comes in at 9.10, which is lower than the industry average of 13.70. This does bode well for their valuation, as it is an indication that they may be undervalued. Their price-to-book ratio is 3.00, so that means they are trading 3 times over their book value. That makes perfect sense for a company of this size, especially when you factor in the massive boost in earnings. I mentioned that they are undervalued, and according to Simply Wall.Street's discounted cash flow model, the fair price for the stock is $120.25, which would mean they are 61.6% undervalued, and conservative me thinks that is a little high, but not unreasonable. Keep in mind, a company may never reach their fair value, and that is not a bad thing as it keeps a good running buffer to grow into. This is a plus for me. So let's look at their returns. Pfizer has a dividend yield of 3.46%, which is paid out quarterly in the amount of 40 cents USD per share. For the American stock, of course, you want to keep this in your Wealthsimple Plus USD RRSP so you can keep all of it for yourself. If you have the CDR version, then the TFSA is a good enough place for it, as well as the RRSP. This is a nice dividend, and it is very sustainable as their payout ratio is only 30.1%. Pfizer has also been increasing their dividend for more than 10 years. So they are, you know what I'm about to say, a dividend aristocrat. When it comes to share price, they entered 2021 at $36.27 and grew that all the way to $57.07 for an impressive return on investment of 43.56%. If we add in the dividends, you have a total return of 47.02%. That is not too shabby. In 2022 thus far, they have fallen to $46.19 at the time of recording for an ROI of negative 14.25%. That is not unexpected with a bear market, and I certainly won't hold that against them. Overall, in terms of growth, they have the best of both worlds with good dividends and a solid growth potential. Now, some of you may think this is my favorite part, but yes, it is time to look at their debt. From their balance sheet, we have a debt of $40.49 billion compared to their equity, which comes in at $87.47 billion. That means their debt to equity ratio is 46.3%, which is not too bad, especially if you consider 5 years ago it used to be 74.7%. They know how to manage debt, though the boost in revenue over the pandemic gets a huge assist on this one. Overall, I like their debt situation as they have their debt and interest payments very well covered. There are no issues here. So what is the final verdict? Pfizer is an absolutely great mid to long-term investment and a welcome addition to most portfolios. Their fundamentals are very solid, with the only concern being the drop in revenue as they transition from the pandemic to back to normal business. Short term, the growth will be slow, but the dividends are there, so you will benefit from that passive income. Like I said, beyond the short term, I love this company. I will be looking to add more of them to my Wealthsimple Plus USD RRSP. This one is 100% worth doing some due diligence on. The fun does not have to end here because you can always watch my video on Canoe that I have linked on the left, or you can check out that video on the right that YouTube thinks you'll like. Your click will decide who is right, and I will see you in the next video.